Welcome to the Daily Update. This is Being Prepared Tuesday, May 24th, where we'll look at the action in the market today and then see how things look for Wednesday, May 25th. And the follow-through that we were hoping to see for Tuesday just did not happen. Although some of our charts are still showing some improvement, but the big rebound that we've been hoping for just has not developed yet. And I have some things that I'm going to cover probably in tomorrow's video, where I'm doing some research and putting together some things to try to suggest, why is this happening? We seem to be coming to the point where we're set up to go higher based on sentiment, based on being oversold, based on a lot of other indicators. We might do it for one day to wear off that condition, but then we end up going right back lower after that. I think I've found some things that may not be the answer, but they may help to explain exactly what's going on. And I have some charts and information that I'll show you. I wanted to wait until after the FOMC meeting minutes are released on Wednesday, because that may be something. It probably isn't, but there's always a chance that the market may see something in those minutes and then end up reacting to it, and that might be a game changer, so to speak. So let's go back and talk about what happened on Tuesday. We did open with a gap lower, and we actually gapped below S1, which was at about 39.28. Selling kept going on there, so it took prices down to S2, which was at 38.82. As the day went on, prices rebounded from S2, but hit resistance back at S1. Going into the close, there was some buying that entered the market, which eventually took prices above S1 and back to the daily pivot, which now that was acting as resistance. And so prices backed off from that going into the close, and we ended up being down 0.81%. We were down a lot more than that. So the rebound that we saw does look kind of impressive, but from a day-to-day basis, we're not really seeing anything on the daily charts that are helping us to confirm that, yeah, we might go higher from here, at least yet. Volume was below average, another thing to be a little bit concerned about, but we had an up day yesterday, and that was on below average volume, and we had a down day today, and that was also on below average volume. So we're just not seeing a lot of conviction. There's a lot of confusion right now in the markets. There's been confusion for a while, and there probably will continue to be confusion until something gets settled, and it's probably with the Fed. What they're probably going to have to do is come out and make some kind of policy statement that the market likes. And then that might be able to take prices higher. Until that happens, we're probably going to be in a pretty frustrated environment. The technicals are still pretty much negative. The markets are focused on inflation and interest rates, which also leads over into growth concerns. We have lots of geopolitical concerns, and then earnings. Earnings were not particularly friendly to the market on Tuesday. So what are some comments that we can make? The rebound has stalled or possibly ended. Now, as I record this, I looked at the futures that we're trading, and this is hours before the open, and they're up, but anything could happen between now and then. Plus, we have the meeting minutes that are coming out, and things might slow down before that happens. So there's a lot of different variables that could affect the overnight trading. The S&P was down as much as 2.5% during the session, and then came back and settled down a little bit over 0.8%. So that's a pretty impressive rebound. The VIX is also producing some interesting information that I'll bring up the chart, and we're just waiting to see that as it unfolds. The 10 to the 5 yield curve is now even. They're right at the same level. Fear remains really extreme, which is another very strange thing that we're seeing right now. We usually see this capitulation where everybody freaks out, everybody's all worried about it. It's all you're hearing about in groups online and on the news and in the media, and then it quickly comes and goes. Well, it's just kind of staying. The S&P is still in correction territory. The economic reports came out, which were also disappointing. New home sales decreased 16.6% on a month-over-month basis, and they're down 26.9% on a year-over-year basis. So that's showing some real slowdown in the economy. The preliminary IHS market manufacturing, and I underlined that because there's a manufacturing part and a services part, that PMI decreased to 57.5 from 59.2. Again, showing economic slowdown. The services PMI decreased to 53.5 from 55.6. Again, another slowdown. Looking at the condition of our trend, it's still negative and getting stronger with the down day. The bias, yesterday I had switched mixed to positive because it looked like maybe something was happening. Now it's back to mixed, more negative, as is the momentum, because we're really in a negative environment right now. And if we see any up move, that just quickly goes away and leads to more selling. Now, at some point that will change, and that can change at any time, but that's the pattern that we've been seeing lately. Let's go back and look at the day's session. First, looking at sentiment, it shows that we are still extreme negative when it comes to fear. We're down at 13. We bumped up from 12, but still, overall, fear is very, very extreme right now. If we look at things on a historical basis, you can see where I put a red circle around us where we've been below 25 for quite a while. Or if you go back and look at other times, we bounce down to this area, come out, and maybe come back down. But we're just camped down in this area for a long time now, and that's not what we usually see. Looking at the VIX, it did advance slightly on Tuesday on a closing basis, and we closed near the bottom part of the bar, so that's a little bit more positive. So there was a lot of movement. The VIX had really spiked up during the day only to close down near the low. The VIX of the VIX is also showing a decline in the movement of the VIX, where on a closing basis it did advance slightly. This is the chart that I've been looking at lately. We're up on the top, and I haven't put any labels on here because I don't know if this is really going to tell us much or not. On the top is a moving average of the VIX to smooth things out a little bit. In the middle is the correlation between the VIX and the S&P, and then at the very bottom is the S&P. What we're really watching is this middle area, and we're really starting to spike up. And especially if we get above this dotted line, what could that be telling us? Other times it just says that, okay, the VIX is going up or down, and the S&P is doing the same thing, so there's a pretty strong correlation between the two. When we get up to this level, it usually means that we're nervous. But if you go back and look historically at what has happened, sometimes we've seen declines, sometimes we've seen advances after we've had an extreme reading. We're not there yet, but this is continuing to climb. And if it does go above this dotted line, then we'll try to fall back and say, okay, what is this chart telling us right now? Another thing that I wanted to display is this chart by Bank of America, where it shows the S&P, which is on the top, as it's going down, but we're seeing a divergence in the VIX. So it's making a series of higher lows. That could potentially be positive. So this is a bullish sign and set up the biggest positive divergence against lower lows on the S&P since March 2020. We did see that where the S&P was going down, we saw a divergence with the VIX going up. That's called a positive divergence. We're starting to see that now over here. Again, another signal that things may be looking better. The Ulcer Index really dropped. That was kind of surprising. So it's really showing on this chart anyway that fear is really starting to drop. But the market really didn't move all that much for this indicator to change so drastically. It's just because it goes back 14 periods and it's readjusting. And here's a longer term look at that chart as well. Equity put call ratio, it rose as can be expected. People were buying a lot of puts on a down market day. If we look at things using our 5-period moving average, we're getting pretty extreme with the put call ratio. There's another chart that I got from Isabel Net where it's just showing the technical overbought versus oversold composite. When it's way at the top, that means that we're overbought. When it gets way down to the bottom, that means that we're oversold. And I put these circles on here, and it's just showing that, yeah, we're really extreme negative. This is a technical score. It takes a lot of different technical analysis indicators, puts them together, and then puts out a measurement that can be measured like an oscillator. And we're way down here. We're at minus 9.44. We had been about this low at the bottom in the financial crisis. We were also this low after 9/11 going into 2002. So usually what will happen is after we get a reading like this, maybe not right away, because we had the reading here and then it was some time after that before the market ended up bouncing. But this is potentially another positive possible setup that might play out in the future. This is put out by Standard & Poor's, and it's just saying what's the probability of a recession starting in the next 12 months, and it's really decreasing overall. It had gotten really high during the COVID plunge. In fact, we did hit a short-term recession during that time, but it's really been trailing off lately. This is a blog post that I found at FactSet, where it says this is the third highest number of the S&P companies citing supply chain on their first quarter earnings calls. When a company comes out with earnings, they not only tell the world this is what we did, there's become this idea of having a conference call where the CEO and a lot of the management of a company will come on and just talk about how great or how terrible things are going to be in the future. And this company, FactSet, they go through and they say, okay, how many times during that call did they say supply chain, supply chain, supply chain? Other times it's inflation. Other times it's whatever word they decide to pick up on. Out of all the companies in the S&P, 336, and that's a little hard to read, have cited that supply chain is part of their scenario right now. It could be positive or negative. And that registers at 73% of the S&P 500 companies. And that's pretty high. It's been higher than this before, but it's still a pretty high reading, just to suggest that the supply chain is what they're using to rationalize what's happening right now in their company. Another chart is the 10-year break-even point. I showed a chart last week where I looked at the 5-year break-even point, but this is looking out into the future to say, okay, what do things look like 10 years from now based on how they are right now? And we're seeing it at 2.59%. That's what they're considering the break-even point to be in the future. And it's pretty high, but it has been coming down lately. We also have the Citi U.S. Economic Surprise Index. This is when a company comes out and gives their earnings report, and if it beat expectations, that's a positive surprise. If it came in under expectations, that's a negative surprise, and Bloomberg does a pretty good job of measuring this. What we have on this chart is the dark blue line. This is the surprise index. When we're above zero, that means happy. When we're below zero, that means negative. And then plotted on top of that is the 10-year Treasury yield. And it just shows how these sometimes move in tandem with each other. Well, we've been seeing interest rates really going up and positive surprises really going down. And so will this adjust at some point? Are interest rates going to come back down so companies are less surprisingly negative? Or are we going to see interest rates go up and companies suddenly not surprise negatively again? Another thing to be aware of is Morgan Stanley put this out, and they think inflation has topped out. Now, others may disagree with that, but this is the report that they're putting out here. This is the U.S. core goods in the CPI that's forecast right now that we will see even more inflation deceleration going into the future. That's just the forecast. It could play out that way. I've read a lot of different things that would totally go against this, but this is what they're going with for right now. Then we're looking back over the earnings revisions, looking at the US, Europe, Asia Pacific, and the emerging markets, and how are they adjusting things? If this line is going up, that means they're adjusting their earnings higher. If these lines are going down, that means that they're adjusting them lower. And the US is really leading the way. It's the dark blue right here with lowering forecasts. So that's just showing more of a slowdown, more economic problems potentially in the future. Let's go in and look at the sectors. It was a down day, so I organized it according to what was down the most, and that was communication. discretionary, tech. They were all down pretty significantly. Some of the sectors that were up: healthcare, energy, real estate, staples, which bounced up a little bit, and then utilities. A lot of the value plays were up. A lot of the growth plays were down. Just to show how things have performed since the all-time high, energy has been the place to be, followed by utilities. Everything else on a pure sector basis has been negative, with discretionary in last place, followed by communication, tech, financials, real estate, and industrials. These are all down anywhere from 14% all the way up to almost 34% since the all-time high. Technical alerts, most of them were negative, with the NASDAQ falling below different levels. The S&P did get below 3,900, and the NASDAQ really had not a very good day. But near the end of the day, the Dow was able to get back above 32,000 and actually closed positive on the day. And oil dropped below 110. It's still very high, but it did come down slightly. Let's go back and look at the intraday chart, where we really gapped lower down through S1. Then quickly, we went all the way down to S2. We broke down a little bit below that, but we were able to build a base and then come up out of that. Well, now S1 became resistance. So then we backed back down, built a little more of a base, tried to go up again. We still saw some resistance at S1, even though we broke a little bit above that, fell back, and then near the end of the day, saw more of an upward thrust, which took us all the way up to the daily pivot. And then we backed off of that slightly going into the close. Here's the daily chart. We're still above this pivot right here, but this overhead pivot is still acting as resistance, and we are below that right now. Here's the longer term machine gun chart, where looking up in the right-hand corner, it just shows that we are still above two different fib levels, which have also served as pivot points. And it's just amazing to me how these things all come together. But as long as we can stay above this S1 level here, that will keep things at least a little more positive. Looking down at the bottom, it shows that volume was up a little bit from Monday, but still below average. Overall, we're down 17.83% since the all-time high. Going through our technical overview, and this hasn't changed. I just have to kind of click through all of these things to show you. If you watched the video last week, you're seeing the same positive and negative things because nothing has changed all that drastically for right now anyway. So we'll have to see if things look better into the future. Let's go in and look at our trend. The ADX continues to go up, and for some reason in yesterday's video I said this red line. That's because I was looking at the red line. But the black line continues to advance. The red line's on top. So that just shows we are in a strengthening trend, and that trend is negative. Our Arun is also coming off a little bit of the selling pressure. When this gets pegged all the way to the top, that means sellers are in full control. We're also seeing a decline in the buying power that's in the market right now. And overall, when you compare the two, our oscillator is negative, but going sideways. Looking at breadth, we saw a little bit of a decline based on price, and we're below an upward sloping moving average. We saw a little bit of a decline based on volume, and we are well below a declining moving average. The 10-day average of highs and lows, it's bouncing up a little bit. It did come up slightly, but it's still pretty extreme negative. Advanced decline ratio, it's right around 0. The blue line is slightly above, the red line slightly below. New highs and new lows. It looks like they're trying to turn up again. We're seeing a little bit of improvement with our new highs and new lows. Looking at the 10-period differential at the bottom, we are still trying to advance. So this is one of the positive things that still remains. Now, if we really break loose and head lower, we're going to lose this. But for right now, based on Tuesday's action, this is still looking more positive. Accumulation distribution, even with the down day, we are still above the moving average. Looking at some of the short-term charts, the McClellan oscillator is above 0, so it's positive, but it did decline. Force index, still looking negative, and I marked off right here where we closed, since that can be hard to see. Stoke RSI, and I called this the Williams percent R yesterday for some reason, but this is the Stoke RSI. It's still showing a bit of an advance, where the Williams percent R is turning down slightly and is negative. Ultimate Oscillator, it crossed above the dash line on Monday. Now it's back below the dash line after Tuesday. Our moving average study is just showing that we're a little bit flat based on the 20. We're still trying to advance on the 50 as well as the 200. Stochastics, they're just bouncing around this oversold territory here. They turned down slightly in the short term. They're still coming out of extreme negative in the intermediate term and kind of floundering around to possibly going back negative with the full stochastics. Intermediate term charts coming out of an extreme negative reading with the rate of change going back 20 periods. Our momentum oscillators, the slope is still looking positive. The MACD is trying to cross. The KST is looking a little better. The TRIX and the PMO are still negative, but trying ever so slightly to at least turn up, where the TSI is also looking more positive. So we're seeing more of a mixed picture with our momentum oscillators. Vortex is still looking more negative. Selling power increased, buying power decreased. Sean Trend Meter still remains extreme negative. The Swinland Trading Oscillator based on price did decline and is slightly negative, and it's also negative based on volume. The BPI, it hasn't been able to break back above 30 yet. If we have any kind of an up day, that might happen and then would trigger a technical alert, but that hasn't happened yet. The PMO, it's trying to turn up, but it's still far away from the moving average. But if you look at things based on price and volume, we have already crossed and are looking much more positive that way. The PMOs that are rising did decline slightly. The PMOs that are giving buy signals is advancing, and we're flat with those that are above zero. Summation index based on price actually continues to advance based on price and volume. Boom indicator hasn't really moved all that much, or I have the red arrows here just to show how far we are away, but we're extreme with the 20. We still have more room to fall with the 200. So we're still looking pretty extreme negative. Chaikin Oscillator continues to advance. Kind of strange there. Ease of movement. It is declining. Chaikin Money Flow, it actually turned positive. So that's kind of interesting. Looking at our intensity of volume, it has really been tapering off. And I kind of explained this a little more in depth in yesterday's video. When we're going up, this is not talking about price. This is talking about volume intensity. When this is going up, that means there's a lot of conviction behind what's going on. When this is going down, that means there's not a lot of conviction. TTM squeeze showing a little bit of improvement, and then using this as an oscillator, we're still trying to come up off of a pretty extreme negative reading. Our different charts, the Heiken Ashi, put in kind of a hammer look here right now if you're into candlestick patterns, but that's filled up, so it's a negative. The Kegi chart and the Renko chart continue to be negative. 3-line break, still looking a bit more positive, because we didn't have enough of a down day to really change that. Our different trading systems, Elder remains neutral with the S&P as well as with the SPY. Our SAR system remains negative. Our go-no-go system is still dark purple, so that is negative. Longer term, we are well below the 200-day moving average. Moving average study, trying to show some improvement after being really, really extreme negative on the 50, flattening to slightly higher on the 150, and still trying to go up on the 200. Special K continues to decline. Here's the crazy fib chart that I came up with, and I added another little line here to try to make it be a little easier to read. But this is a pretty significant level, right at about 38.29. And we did drop a little bit below that, but we're able to come back above. Well, that's not only a 38.2% retracement going back from the COVID low to the all-time high, it's also a 61.8% retracement going from a significant low set back in 2020 to the all-time high, and these are overlapping each other. So there is some significant support there. And on our intraday charts, we see pivot points also near these levels as well. This is a weekly chart just for a reference point where this is going back and showing pretty much the same level that I was showing you, where we bounced down to this level, and so far we've been above that. Looking at some broad market indications here, the diamonds remain neutral, as do the Qs. The Vixen, it didn't really spike up all that much with the decline, and we ended up closing closer to the bottom, but we did advance overall. Looking at some broad market issues, are we seeing the dollar spike? It really spiked up here and has been having a lot of trouble ever since then. Here is this chart that I posted last week, where this is when they posted the chart. We're down here now where the laser pointer is. But other times when we saw a spike, that can often mean a real significant decrease in the dollar, which may end up helping stocks. They like a weaker dollar. It makes their books look better. It also helps imports and exports. Oil declined about 0.5%. We're at 109.77. Gold is trying to get back above the 200-day moving average on the futures chart, as well as in the ETF. And this is looking a little better, where we had an open on the left-hand side, and then we closed on the right-hand side, where on Monday we opened and we had an up day, but we closed lower than the open. And here's a longer-term look at the gold ETF. Silver was also up 1.44%. This bar is also looking healthier, but we're still keeping an eye on this potential death cross that could be happening. Here's the long-term look at the silver ETF. I'm just pointing this out because of all the different Head and Shoulders dandruff shampoo things that you see here. But as far as Bitcoin itself is concerned, it's 30 is the real line in the sand. As I started recording, I think Bitcoin had gone a bit above 30, but we spent a lot of the day on Tuesday below 30. Looking at bonds, are they bouncing finally? We're seeing interest rates coming down as bond prices go up. Is that showing us some kind of a bounce from these extreme negative prices? The yield curve, I just wanted to point this out because they are exactly the same right now with the 10 to the 5. This is showing how interest rates have been coming down in the longer term maturities and actually declining a little bit in the 3-month. This is showing recent weakness in the yen, but it's recovering a bit. Recent weakness in the euro, also recovering. Recent strength in the dollar, but now showing some weakness. And here's a chart of the euro against the dollar. The euro's at 107.36. The dollar's at 101.87. So they're quite far apart based on where they were just a few days ago. This is the chart that kind of defies what's happening right now when we see interest rates going down and stocks going down together, which is what we saw on Tuesday. We still see a really high correlation between the two, which is very strange. They tend to move in opposite directions. Looking at our possible positive scenarios, the Copic curve has crossed over positive, so now we'll have to wait and see. This does not tell us what's going to happen. This just means, okay, something's going to happen, but you're going to have to look at other things to tell you whether it's up or down. The 2-year Treasury, it declined a little bit, so has it spiked? It's really too early to tell. The mass index has not dropped below 26.5, so no second signal yet. Praying bottom fisher has crossed over. A lot of times we use this indicator for finding lows in the market, but we can get faked out with this indicator. But we have crossed over, so this is suggesting that maybe we've bottomed out here and could be headed higher. But we've been fooled by this before. The small cap ratio to the S&P 500, we're not seeing a spike. In fact, the ratio declined. That would be another nice thing to add to our overall mixture of what's happening right now, but it's just not developing. And I know it's hard to see, and I'm trying to zoom in on this to show how we want to see a real spike up. And then a few days after that, sometimes the S&P will spike up in answer to that. This is not looking as viable, but still looking viable overall. where we saw a spike in the staples ratio. It came down, but then it really advanced on Tuesday. If it keeps going up, we're going to lose this spike. So that's another one that we kind of have to wait and see what will happen. So what's our outlook then for Wednesday? The technicals are negative. There was no follow-through buying. That was a disappointment to those that are really bullish. Sentiment remains extreme negative. We're still battling between growth and value. Tuesday was more about value than growth. The economic reports that'll be coming out are the weekly mortgage applications index, durable goods. That can be kind of a big one. And the crude oil inventories, I usually don't put that one up here, but sometimes it can freak the market out. The big one is probably going to be the FOMC minutes. And those will be released at about 2 p.m. Eastern time. People will be reading through that to find any secret hidden meaning. And the market sometimes will react to those things. And they can see how the people on the committee voted and things that they said and either take that as positive or negative. Geopolitical events, Russia, Ukraine, which continues to go on and on and on. Supply chain issues, inflation, interest rates, which are producing a lot of growth concerns. We want to keep an eye on oil. Earnings as they come out. I changed this a little bit, Fed speak, and then policy, because I'm going to be addressing that in tomorrow's video. And then we're also keeping an eye on the longer-term scenario playing out in Japan. So our scenarios for things to keep going down: rising interest rates, inflation fears, growth concerns, earnings, Fed speak, gravity. It seems like anything can pretty much make this market go down. And then fear. We're camped out at extreme fear right now. The technicals are negative. So the path of least resistance is still down, but we're seeing some potential positive things. What can make the market go up from here? The technicals are negative, but they're still showing some improvement, as I tried to point out, and sentiment is still extreme negative, which could be used as a contrary indicator. The possible positive scenarios, the Kopit curve and the Pring bottom fisher have turned up. Okay, we have two. The staple spike, which was looking really good after Monday, is not looking as good right now, but it still could be spiking. So that we have three possible signals that sometimes occur when we see a bottom in the market. So that could be something positive, but we need to see follow through with price. The technicals, where I added fib retracements, they can play a real role either as support or resistance. And the previous levels that we hit can also provide support or resistance. Our sideways scenario is just not viable right now because the ADX is well above 20 and advancing, and it is negative. So our conclusion then is the S&P is negative. Short-term negative, showing some improvement still. Intermediate term negative, maybe improving. Long-term negative. So thank you. I hope you have a wonderful Wednesday, and I'll prepare the next video after Wednesday's session. And yes, I'm talking for a few extra minutes here to add some more extra time to this so that I can put the end cards up without it going over top of the information that people couldn't see in the video.